Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So I've just brought up, this is a chart of EUU. This is on a trading application from this is Thinkorswim. I imagine quite a few of you are familiar with the platform. And underneath the chart of EUU, I've got graphed implied volatility levels. So everything's moving along, we're between 10 and 12%, and then all of a sudden we're up here at 17%. So as the market started to collapse and all this uncertainty began to emerge, in Europe, we get this volatility ramping up. Well, eventually volatility reverts back to where it's been, to its averages. We don't know when, unfortunately. It would be great if we did. We can even trade that. But eventually it will, and that could really hurt us. So it's kind of, we're adding a risk to that long position that we can offset to a great extent by spreading the position rather than just going long alone and not offsetting it with a little bit of a short by selling another put against it and absorbing some of that time value in that put. Okay, let me go back to the chart here. Let me stop sharing. Okay, so I've got a question here. So I wanted to throw basically three ideas out today and go through a case study. And each one of these, the market's at an interesting situation in that, we're kind of hitting support levels or resistance levels depending on what instrument you're looking at. Everything overall is kind of correlated with the dollar. The dollar's being the dominant force with the exception of the yen. Out there in the Forex market, everything's kind of trending in favor of the dollar, and we've had this little bit of a pause in that strong dollar trend the last few days. So the market's likely to break out. So we're looking for short-term opportunities. Each one of these three may be interesting opportunities, but at the same time, we want to think about if we want to achieve the objective of limiting our risk. Taking a diversified trade or a hedge trade or something that's going to offset some of the risks we may be exposed to elsewhere in our portfolio, but we still want to limit risk. There are some dangers that we're exposed to right now because the market has been moving so fast. And so these were three ideas to take advantage of that. Personally, I think a breakout's quite likely. I think the market's bias right now is towards panic. And if we get some bad news or more, big bad news, the bias is so strong to the downside, I could see this continued flight into quality, and that would be probably harmful for equities, but could be very good for the dollar. Could be really bad for the pound, could be bad for the euro, and could be good for the yen. So we kind of know how this little circle of cause and effect may work out over the next couple of weeks, or even the next few days, depending on when we start to see the market begin to move. And we can start to plan some strategies to take advantage of that movement using currency options as an alternative, and in addition to some of the things we may be doing in stock options, stock index options, or stocks themselves. Okay, so let me answer a couple of questions. Carlos is asking me, what's the difference between EUI and EUU, and when should you use one versus the other? So the index we've been looking at here is EUU, which is the euro versus the dollar. So if you were looking at this as like a division problem, it'd be EUR divided by USD. Right now it takes $1.23 to get into a euro. EUI is just the reverse. It's the dollar/euro, which is the way that futures contracts are priced, but it's different than the way that the spot market works. So typically, if you're working with like a dealer, you're used to seeing it as EUR USD, so euro dollar rather than dollar euro. So EUI and EUU, they're just the inverse of each other. That's basically the bottom line. I don't know that there's, with those two, they're both fairly liquid. So I don't know that I would really point out that one is superior to the other. It's probably just a matter of your comfort and convenience. If you're used to seeing the dollar and euro quoted as dollar euro, then EUI is probably the one to trade. If you're used to seeing it the other way, which I know a lot of individual traders are from the spot Forex market, then EUU is probably the instrument to be looking at. But in both cases, they seem, to me, when I watch prices during the day, they seem to be about as liquid as each other, so I don't think that there's any other inherent advantage. Okay, so TJ is asking, is it tougher to get out of spreads quickly with a profit before expiration? So TJ, I'm just going to answer this with my opinion. It does depend on how liquid is the underlying, as well as the options that you're trading. Sometimes a multi-leg spread can be tough to get out of if you're trading something that's really illiquid or has gone way out of the money or something like that. But I wouldn't anticipate, sticking with things like EUU as an example, or YUK on the yen. I wouldn't anticipate that you would see big problems in getting out of the trade, a spread trade, any more than getting out of a single leg. So if you're sticking with liquid, option contracts, you're probably okay. I always suggest, though, these are great questions for brokers. So, talk to your broker, because it would be interesting to find out if they have suggestions for you that that you can do to expedite that as much as possible. Entering the trade as a spread or legging out of it or whatever it is. They may have some suggestions that would as to how to do that in the best way with their particular platform, or they may have a way to do that. But I wouldn't anticipate that you'd see big problems personally. So TJ's asking a follow-up question here: are you always safer with a spread? It's all relative. It's like this comparison that we were looking at on EUU, where we looked at the $3 put versus the $2 debit spread. Well, clearly the debit spread in my example is superior to the $3 put, right? Assuming that the market only gets to 120. The market winds up not moving very far and just moves down to 120. If the market moves a lot, you may have taken more risk with the long put position, but you have unlimited reward potential. Your reward is fixed with the spread. So safer is kind of a relative term. It's like, well, with a spread, quite often it's true. You have less at risk, but you plan to make less as a maximum gain. You may have more at risk with an outright long position, but when you win big, it can be unlimited. So it could be hundreds of percent. So it's kind of a trade-off. And I would suggest that if we can theorize that options are fairly efficiently priced, it's probably pretty equivalent. The trade-offs are about equal.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.